we talk about beta, which will be our measure for the market risk. And it basically tells us how individual stocks react to the changes in the markets, which is exactly about the market risk. And let's go here. So capital asset pricing model, which is seriously a very, very important model, which is widely used in industries as well. It basically tells us the relationship between risk and return. We expect that high risk should translate into high return anyway. But here, basically, capital asset pricing model is going to tell us this thing. So for each stock, for each individual stock, your required rate of return, your minimum required rate of return will be the total of risk-free return, which is basically your reward for waiting and not consuming, not spending your money today. And it's the minimum that you can get in the economy, the riskless rate. On top of it, you want the reward for bearing the additional risk. And this risk will be the systematic risk. So together, they're going to give you what the return should be. So we're trying to price risks, okay? A couple of things that are important. Let's go here. So here, we can write this equation with the CAPM formula. So it will be risk-free return plus market risk premium, how the market does on top of the risk-free rate, which is called market risk premium, okay? And since I'm trying to price the systematic risk, I need to consider beta. Here, I'm going to have beta. So beta times the market risk premium will give you the risk premium, basically, of any asset. Okay. So this is the CAPM equation. So for each stock, you want the reward for waiting, which will be given by the risk-free rate in the economy. On top of it, you want the reward for taking additional risk, taking the systematic risk. And this will be given by how your stock reacts to the excess market return, let's say. How the market returns compare to the risk-free rate. So my question is, for different stocks, is the risk-free rate same? For different stocks, is the risk-free rate same? Yes, the risk-free rate is the risk-free rate in the economy, right? It doesn't change with the stocks. Is the market return same for individual stocks? Yes, it's all same. For risk-free rate, we mean treasury bill rate. For the market return, we mean what? We just talked about it. Market return is what return? What index? Okay. S&P 500 index. So this is also same for every stock. So what gives the differences in the expected returns is this guy, beta. So this will be same for every stock. This will be same for every stock. So this beta, which measures the response of your stock to the market risk, will give us the differentiation in the returns. So this is basically CAPM, capital asset pricing model. We're only pricing the market risk. That's it. Nothing else is important. So. Okay. This is how, this is the security market line, which is the graphical representation of CAPM. This is also important. Here on the x-axis, we have beta. On the y-axis, we have the expected return. So in order to graph the security market line, graphical representation of CAPM, we need to know two things actually. We need to have two dots. One dot will be your y-intercept. When your beta is 0, what is the expected return? The other one is when your beta is 1, what is the expected return? So let me ask you two questions. What is the beta of the market? 1. What is the beta of the risk-free rate? Beta of the risk-free rate. Thank you. Beta of the risk-free rate should be 0. Hocam neden? Because beta only measures the market risk and how the stock return will move according to the market. And since we are using the risk-free rate, there should be no risk in the risk-free rate. So it's a fixed number. So it's not going to change according to the market. Of course, in real life, risk-free rate changes according to the market conditions. But again, the risk-free rate we are using here is not really risk-free. And the market index we are using is not really the market index. Risk-free dediğimizde hiçbir risk olmaması lazım. Tabii ki T-bill'de de bir risk var. Ve market dediğimizde markette olabilecek her türlü yatırımın göz önüne alınması gerekiyor. Biz burada sadece S&P 500 alıyoruz. Tabii ki gerçek hayatta biz beta'yı sıfıra yakalayamıyoruz tabii ki. Ama we need to have simplification. So we are assuming that risk-free is really risk-free. It doesn't move with the market. And this one is easier to understand. The S&P 500 index reflects the market fully. These are our assumptions. So in this question, if the risk-free rate is 4% and the market rate is 12%, then when the beta is 0, is the risk-free, okay. For the risk-free return, risk-free investment, beta is 0, and the risk-free return is 4%, so you can put the first dot here. And then for the market, the beta is 1, and the market return is 12%. Once you have those two dots, you can just connect the dots, so it will give you the security market line for your investment. What is the slope here? What is the slope of the security market line? Okay. So here I have the market return minus the risk-free return over beta, which is equal to what? 8%, which is the market risk premium. So the slope of the security market line is the market risk premium. This was a fill-in-the-blanks question before in an exam. So this is the slope of security market line. So market risk premium is the difference between the market return and the risk-free rate. Here it should be 8% because the market offers you 12%, risk-free rate is 4%, so market risk premium is 8%. So this is how your security market line graphical representation of CAPM should look like. Let's continue with, or before that, no, okay. Let's look at this question. What are the risk premium and expected rate of return on a stock with beta 1.5? Assume a treasury bill rate of 6% and market risk premium of 7%. So let's read it again. It says, what are the risk premium and expected rate of return on a stock with beta 1.5? Assume treasury bill rate is 6%, which is a risk-free rate. Market risk premium is 7%. What is the market return in this question? What is market return in this question? What is the market return in this question? So beta is 1.5. Market risk treasury bill is 6%. This is 6%. Beta is 1.5. Market risk premium is 7%. If market risk premium is 7%, what is the market return? 13. Thank you. So this is 13%, right? This is 6%. So market risk premium is 7%. Why am I saying this? Because sometimes in the exam we're giving you market return, sometimes market risk premium, and you get confused for some reason. There's no reason to be confused. So market risk premium is 7%, market return is 13%. So from here, the question says, what is the risk premium for this asset? What is risk premium? It is beta times market risk premium. So it is equal to what? 1.5 times 7%, which is 10.5%. This is the risk premium. What is the expected return? What is the expected return? 6% times the risk, plus the risk premium, so it should be equal to? Doğru mu? So you have 6% of risk. Bir dakika. Abi bu. Kapak karışmış. Okay, so you have 6% of risk-free rate. 1.5 is beta. Market risk premium is 7%. So beta times market risk premium is the risk premium. So it should be equal to 10.5%. And one thing I asked was, if market risk premium is 7%, then what is the market return? For that, you're adding the risk-free rate to the market risk premium. So market return should be equal to 13%. And the expected return is risk-free plus the risk premium. So it should be equal to 16.5%. Okay, so it's just plug the numbers in the formula kind of thing. Let's look at the second question. How would you construct a portfolio only with treasury bill and the markets? Okay, you're gonna invest in treasury bill and the market index. How would you construct a portfolio with a beta of 0.25? What is the expected return to this strategy? Assume treasury bills yield 6% and the market risk premium is 7%. So you're gonna form a portfolio, but for the portfolio, you want to have only two things. Okay. So in the portfolio, you're gonna have the treasury bill and the markets index, and treasury bill is giving you 6%. Market risk premium is 7%, so the market gives you how much? Market risk premium is 7%, so what is the market return? 13%, right? So market risk premium is RM minus RF. If this is 7%, if this is 6%, then the market should give you 13%, değil mi? Okay, so you want this portfolio to have a beta of 0.25. So you need to put some weights on the risk-free rate and the market return to have a portfolio like this. And if you remember, portfolio beta formula was the first stock's weight times the first stock's return plus the second stock's weight and second stock's return. So if you have all those information, how do you construct a portfolio like this? What are the weights you would assign to the risk-free rate and to the market? So basically what we did here was, it was just algebra. What we did was this. So in the first part, we are asked to calculate the weights to have a portfolio like this. So I want the portfolio beta to be equal to 0.25. And I'm going to use two assets. One will be the risk-free, and the other one will be the market. And the risk-free beta is 0, and the market's beta is 1. So to have a portfolio which will have 0.25 beta, what should I do? I'm going to put some risk-free with weight of risk-free, plus I'm going to put the market's index with the weight of the market. So since the portfolio beta should be equal to 0.25, I know that weight of the market should be 0.25. But you can also write it like this. This is 0 times 1 minus the weight of the market, because you have two investments. And the total will give you the total of the pie, basically, plus 1 times the market weight. So market weight should be 0.25, and the weight of the risk-free should be 0.75 from this equation. Any questions here? Ya burada 0 ve 1'lik bir şey olmasaydı da yani risk-free ve market değil de stock A, stock B olsaydı da weight'leri şu şekilde yazdığınız anda denklem çözecektiniz, değil mi? Bir sorun olmayacaktı. Bunu bu şekilde yazmayı bilmemeniz gerekiyor, unutmamanız gerekiyor. So this was the first part. In the second one, I'm asked to calculate the expected return of the portfolio. For that one, risk-free is equal to 6%. Beta of the portfolio is 0.25. Market risk premium was 7%. So from here, expected return should be equal to 7.75%. There is another way to do it. And if you remember in the previous lecture, we learned that you can write the portfolio return as the weighted average of all the returns in your portfolio. That's why I was confused with this one, actually. I was thinking about that one as well. So expected return of the portfolio will be the weight of the risk-free times the return on the risk-free plus weight of the market times return on the market. So we can also find the same answer, not using CAPM, but using the weighted average of the stocks. So you can write it as, I have 0.25 risk of the markets. The market return is 13%, plus I have 0.75 of 75% of my money in the risk-free rate, and then the risk-free return is equal to 6%. So together, the expected return will also be equal to 7.75%. So you can solve it two ways. So this is the CAPM way, where you have the betas. Here, this is the portfolio return, like we did in the previous slides. Previous chapter, I'm sorry. So the return on your portfolio will be the weighted average of the stocks in your portfolio. So you can also solve the question like this. Any questions? Okay. So once you know that, what we learned about the CAPM and the security market line is this. Security market line, which is a graphical representation of CAPM, it's an upward sloping line, which means high risk, high beta, translates into high return, just like we expected. And we know that beta of the risk-free asset is 0, beta of the return, market return is 1. Slope of the security market line is the market risk premium. So this is a summary of what we saw so far. If you have a this is important, if you have a fully diversified portfolio, then all the assets should lie on the security market line. So CAPM should work perfectly. Now, since you woke up, let's talk about something important, which I always try to ask in the exams as well, so more awake. But I never lie about those things. I really ask those in the exams. So this is important, and this will take us to our undervalued, overvalued stock story, okay? So suppose that I have 3 stocks, A, B, and C. And using some techniques, you're estimating those returns, estimating returns for those stocks. Maybe you use historical returns, maybe discounted cash flow analysis, and you estimated some returns. And you know the betas of the stocks, okay? You calculated them yourself, or you found it on Yahoo Finance, Google Finance, whatever. And then you know the market risk premium, you know the market return, you know the risk-free rate, and you know the betas of those stocks. So you use CAPM to calculate the returns of the stocks, your estimated, your required returns, what the model predicts. So if you do that, since stock A has 1.5 beta, you're multiplying 1.5 with the market risk premium, and you're adding the risk-free rate, and you're finding the CAPM. Bu sayıların nereden geldiğini üzerine durmama gerek var mı? Hepsini beta times market risk premium plus risk-free. So you estimate, you have the estimated returns using the market values, let's say, and you have the CAPM, what the theory predicts. So once you have these, you can plot the security market line. When the beta is 0, I have the risk-free rate, 7%. When the beta is 1, the market return is 16. So if you connect those 2 dots, you're going to have this upward sloping security market line. Then you can say, okay, put those stocks in the security market line. So if you pay attention, you would see that C, security C, is what CAPM says is the same with your estimations. So C should be on the security market line. For A, the estimated beta is 1.5. CAPM tells you should be at 20.5. But your estimated return is 16%. So this is where A is. And similarly, this is where B will be. Okay, so at the 1.5 beta, the CAPM says return should be 20%, but actually your estimation says, no, you're at 16%. So you put those 3 things in the graph. So my question will be this. When you have security market lines and estimated returns like this, what will happen to the price of A, B, and C in the economy? If CAPM works, which one, if CAPM is a well-working theory, which stock is overvalued, which is undervalued, which is fair valued? Let's start with the easy one. Which one is the fair valued? C is the fair valued because your estimations are same with what CAPM predicts. So if CAPM works, all the securities should be on the security market line, and C is exactly on the security market line. Now let's look at B, for instance, okay? Let's go to B. Do you think B is undervalued or overvalued? Huh?
Undervalued.
Undervalued. Who says undervalued? Kağıtları çıkarınlar. Okay, who says undervalued? Who says overvalued? So if CAPM works, all prices should go toward the security market line, right? Do you agree with this? If CAPM works, all the returns should go to the security market line. For B, the return for a stock which has 0.5 beta, CAPM says its return should be equal to 11.5%. CAPM says B should be here, but your estimation says, nope, B is offering 13%. So is this overvalued or undervalued? Valuation is not about returns, it's about prices. If the return you estimate is higher than the return that should be, what can you say about the price? Right now it is underpriced. Why? Because its return is higher than it's supposed to be. If you pay less money, then you expect more return for an investment, right? For the same investment, if you pay less money, your return will be higher. Karlı bir şey yapıyorsun, az para ödüyorsun. So for B, since your estimated return is higher than the required return, it means its price is lower than it should be. In that case, people will rush into buying stock B, its price will increase, and once its price increases, return will decrease. And you're going to hit the CAPM line. So B is actually undervalued. Since it's undervalued, you're going to buy, everybody will buy those securities. The price will increase. When price increases, return will decline to the CAPM level. So it is above the security market line, but it is undervalued, just the opposite. You can do the same thing for A, okay? CAPM says A's return should be 20%, but your estimation says the return is 16%. So the return is less than the required one. So its price is higher than the required one. In that case, this is overpriced, it's overvalued. In that case, people will stay away from stock A. Stock A's price will decline. As the price decreases, return will increase, and you're going to hit the CAPM. So if CAPM works, then A is overvalued and B is undervalued. So this is how their prices will change. Any questions here? Okay. I think it was good. Okay. Do you have any questions? I'm going to summarize in the last 10 minutes. And then I will talk about whether CAPM works, CAPM doesn't work, and some other models very briefly. I think I have like 10 slides or so left, so we should be fine. So summary of CAPM. One thing, investors do not like risk. We already know that. And when you take more risk, you want more return. You know that with diversification, you can diversify away the unique risk. If you add more stocks in your portfolio, you reduce the unsystematic risk, the unique risk. The risk you cannot get rid of is the systematic risk. It's the market risk. So for CAPM, we are basically trying to figure out how adding a stock in your portfolio, in your well-diversified portfolio, will create for you. What kind of return it will create for you. If you have a well-diversified portfolio, you're getting rid of all the unique risk. You're just left with the market risk. And since beta measures the market risk, you will have an idea about how much return you're going to get every time market return changes. So that's why beta is important. And beta gives you an idea about the reward for bearing the systematic risk. When we talk about individual portfolios, we look at their standard deviations. But CAPM is more like a portfolio-based theory. So it cares more about how adding an additional stock in your portfolio will change the market risk response of your portfolio. So that's a slight difference between what we did in the last chapter and what we are doing in this chapter. So how well does CAPM work? I already told you CAPM is still widely used, the number one asset pricing model used in the system, in the industry. CEO, CFO still use CAPM. It is highly relevant. It's very easy to use CAPM. If you take financial management class, I think you have projects that will make you calculate betas. It's not difficult. It's like an Excel function. It will take only maybe like 30 minutes of you. To calculate betas. It's not difficult. That's why it's widely used. Everybody can do it. So CAPM has very strict assumptions. So there's no tax in the economy, there's no transaction cost, there's no private information. Whatever CEO knows, you know. You can trade all assets. You can infinitely divide assets. So you can have 0.5 of a stock, for instance. You can borrow or lend at the risk-free rate. It's so easy to borrow money at the risk-free rate, lend money at the risk-free rate. These are not very realistic assumptions. CAPM, I think people came up with CAPM in 1950s. Other academicians relaxed those assumptions. People are still trying to test whether CAPM works or not, and the verdict is still on. We don't know. It's still used. Some people say it doesn't work. Some people say it works. But let me show you a couple things. CAPMs, let's say your great-grandfather decided, or let's say you have 10 uncles, okay, great-uncles, great-great-uncles, and in 1931, they formed 10 different portfolios with different betas. The oldest uncle had the high beta portfolio. The youngest uncle got the low beta portfolio, okay? And they invested in those portfolios. And then in 2002, we were curious about how returns changed according to their portfolios, okay? So this is the security market line. If CAPM worked wonderfully, all the portfolios should lay on the CAPM, right? So you have 10, 1, 2, 3, 4, 10 different portfolios. If CAPM works, all the portfolios should be on the security market line. So this is the high beta portfolio with your oldest uncle. This is the low beta portfolio of the youngest uncle. So what CAPM predicts is, you can see that this doesn't work perfectly. Like, not all of the portfolios are on the security market line, which means beta was not enough to explain the returns. But still, it has some promise because low beta portfolios brought low return compared to high beta portfolios. So it seems like CAPM actually worked. It doesn't look bad. Bunu görüyorsunuz değil mi? Beta ne diyor? CAPM ne diyor? Low beta portföy high beta portföyden daha az getiri getirmeli. Gerçekten de öyle. Tam olarak security market line üzerinde değiliz ama yine de çok kötü değil durum. So this is how things changed from 1931 to 2002. Let's do the same exercise from 1966 to 2002. Daha yakın bir zamana bakıyoruz. And your uncles are doing the same thing. You have the youngest uncle with the low beta portfolio. You have the oldest uncle with the high beta portfolio. Again, portfolios are not on the security market line, but things look worse now. As you can see here, these are lower beta portfolios. Their return was almost same with the high beta portfolio. These are with real numbers, by the way. As you can see, as you come closer in the timeline, CAPM starts to fail. So some people say CAPM is a good model if you start from 1930s. When you look at from 1960s, it doesn't work that well. Other people said, they said it is ridiculous to look at one factor. You're only looking at market risk, which is ridiculous. So they said there are other factors that should be priced as well. Fama French, the guy who got the Nobel last year, is one of the guys who came up with 3-factor models. And they look at 2 more factors. They look at the size of the companies. They look at the market-to-book values of the companies. Let me try to explain what it means. They created portfolios with 2 more factors as well. Here, they created a portfolio where they buy small stocks and sell big stocks. They also create another portfolio where they buy high book-to-market stocks, value stocks, and then they sell growth stocks. So they created those portfolios. If those factors didn't explain anything, you wouldn't see a trend in the line. So from 1920s to 2000s, they look at how those portfolios moved, and they show that small companies bring more value than small companies bring more value compared to the big companies. They also show that growth and value companies also create a new factor as well. So they said one-factor model, CAPM, doesn't work. So you need to use three-factor models. They came up with this in 1996. Now all of us has to use those factors as well. Like as robustness check, we say, our results hold for anything. We use CAPM, we use Fama-French factors as well. So this is the three-factor model. Okay, last couple of things. Do I have time? 2 minutes. So we're using CAPM because it is easy to understand. It is widely used. There are other models as well. They come up with different factors as well. So as a robustness, we can use them. They are tougher to figure out. Okay. And with those CAPMs, with CAPM, what we're trying to do is we're trying to price risk. We are pricing the systematic risk. We believe that you can get rid of the unique risk by diversification, so we're not pricing that. Some people say CAPM is great, some people say CAPM is not great. The verdict is still out, so do you have any questions? Uh-huh.